Okay, good afternoon and welcome back everyone to our Options Foundations education course. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. And today we're going to talk about one of the foundations of options trading, which is the difference between buying versus selling options. They are very different in nature. They are used in, I would say, arguably very different use cases. So today we're going to talk about what the differences are, even though you have multiple strategies that are technically bullish, multiple strategies that are technically bearish. What are the differences between the two, and when should you utilize each one of those strategies? Because these are truly the foundations of more complex options. If you can understand these four core strategies in and out, then you'll be able to understand any complex option strategy because they're built on these four fundamental building blocks. So that's why this session is so important. And hopefully today, after we finish, you'll have a good understanding of these foundational building blocks to allow you to trade, either simple or complex options with the same understanding of each one. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we're going to use as examples during our session here today. And just to remind you, this is a 4-part course. You might have joined us last Tuesday, where Jessica walked you through the introduction to option Greeks. Today, we're talking about buying versus selling options. Next week, we're going to be talking about using technical analysis for options trading and learn to trade vertical spreads on the last session here for the week. And we're here to try to help you understand kind of the foundations that you need to master your options trading process. So hopefully you've joined us here for the past Tuesday, and you'll be joining us here again next week. So what we're going to cover here today is we're going to start off by talking about the basics of what the differences are between trading stocks versus options. We're going to talk about the 4 basic strategies and just understanding these 4 basic strategies if you've never learned them before. And then we're going to dive into bullish strategies, which is buying calls versus selling puts. And then we're going to look at bearish strategies, which is buying puts and selling calls, and what the primary differences are between these 2 primary buying versus selling options. And then we're going to talk a little bit about in the context of options Greeks that you learned a little about last week. And then we're going to go through some examples with Q&A during today's session. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to what is the fundamental difference between buying and selling options. Now, how many of you have both purchased or sold an option before? Please type 1 into the chat window if you have traded either buying or selling an option before. Okay, I see a lot of 1s, which is perfect. And so many of you that have bought or sold options, hopefully today will give you a better understanding of that, specifically around when you should buy an option, when you should sell it, what are the advantages, what are the disadvantages of each one. And that's going to also help inform, the next few sessions as to how you can improve on these sessions, on these strategies during my last session on trading kind of vertical spreads. So I'm going to be using the Options Play platform here today. Many of you that are viewing this today are familiar with Options Play, but if you're brand new to Options Play, if you've never signed up for it before, you can sign up for free at optionsplay.se, courtesy of the NASDAQ exchange. They're providing all Nordic investors with free access to Options Play Nordic at that URL above, optionsplay.se. So if you are brand new to Options Play, you can sign up there to follow along some of the things I'm going to show you during today's session. So let's start off by talking about a stock position, because most of you that have traded options have likely traded in a stock before, and the question is whether or not you might be buying a stock or shorting a stock. Now, most of you probably have bought a stock. Many of you may never have shorted a stock. So we'll talk about kind of the advantages to options from this perspective and what are some of the disadvantages as well. So when you're buying a stock, we call this immediate gains, meaning if you buy a stock and the stock ticks up, by even one crown, you'll be profitable. If it declines by 1 crown, you'll lose 1 crown. So you have immediate gains in the direction if the directional view that you have is correct, and you're getting symmetrical exposure, meaning you know exactly how much potential you can make if the stock goes up by 10 crowns, you know exactly how much you would lose if it declines by 10 crowns. And the benefit of trading stocks is that you can hold on to the trade for any time horizon. You can buy the stock and sell it a few minutes later, or you can buy the stock and hold on to it for years. There's no limit as to how long you can hold on to a stock for. But there are some limitations, meaning there are no neutral options. So for example, if you think a stock is fairly valued and it's just going to stay where it's currently trading, there's really not a good way to profit from that if you're trading stocks. Meaning, if you think a stock's not going to make a big move, you generally would avoid buying that stock because that would go against the reason as to why you would buy a stock. You will only buy a stock that you think is going to rise in value in the future. So, this is something that I think everyone that's watching here today is largely familiar with. So let's talk a little bit about the 4 basic strategies for stocks, for options. Now, remember, you have a call or a put option, and you can either be a buyer or you can be a seller of a call or a put option, which means that there are 4 possible strategies. Now, the best thing to use is a T-chart to remind us, the obligations that you have as a buyer, which is the right to buy or a right to sell for a call or a put, or the obligations that you have, which is the obligation to sell or the obligation to buy. And it's always the buyer that initiates the exercise of the option. So with any option contract, you have a few different terms of the contract. It specifies which stock or ETF the option is listed on. It has the time of the expiration at which the exercise can or the option contract can be exercised upon. It also has a specific strike price or the agreed upon strike price at which the option will be initiated at, and it's always the buyer that has the option to initiate the contract or exercise the contract. So the best way to remember this is a T-chart, because a buyer of a call is a bullish strategy, a buyer of a put is a bearish strategy, and vice versa. A seller of a call is a bearish strategy, and a seller of a put is a bullish strategy. Now, this can be, in theory, confusing, but I think the best way to sometimes think about it is positive and negative. I think everyone can understand why longs are positive and shorts are negative, and calls are positive and puts are negative. And there's just a typo here. This should actually be a negative. But basically what you can do is you can just match the signs. Positive and positive is bullish, positive and negative is bearish, negative and positive is bearish, and negative is bullish. And that's kind of an easy way to help remember whether a long call, long put, short call, short put is a bullish or bearish strategy. Now, I will say that even though both of these strategies are bullish, they're not quite exactly the same. And that's exactly what we're going to dive deeper into today, as to why these two are not the same, even though technically we call these both bearish strategies, and we call these both bullish strategies. And that's where we're going to spend some time during today's session, is diving into that. So let's start off with a simple strategy, a long call. This is a strategy that most of you probably have at least heard of, if not have executed in your own account. And on the surface, a long call looks extremely attractive from the perspective of, we talked about a stock position before. If the stock position, if you're correct, you are immediately rewarded with gains on the trade, and there's unlimited upside, right? If you buy a stock and the stock keeps going higher and higher and higher, you keep making more and more money. But there is a downside to the stock, right? If the stock declines more and more, all the way down to zero, you will continue to lose more and more money. So when you first learn about a call option, it looks very attractive because you have 2 characteristics. One, you have unlimited upside. If the stock that you buy a call option on continues to move higher and higher and higher, you will make more and more money. But on the downside, if the stock goes in the opposite direction that you expect it to, well, you have limited losses, and the losses are limited to how much you pay for the call option. So if I have a $100 call option and I pay 4 crowns for it, then my max risk is 4 crowns. but my max reward is completely unlimited. And when you first learn about this as an options trader, you think to yourself, why would I ever buy a stock? Why would I not just always buy the option? Because I participate on the upside the same way I would as a stock. And if I'm wrong, I I don't have huge losses. And if I bought this stock, I would have to pay 100 crowns. Now I only have to pay 4 crowns. So I'm leveraging my capital. Not only do I get leverage to the upside, fantastic, but if the stock doesn't go in the direction I expect it to, I don't blow up my account. Doesn't this seem like the best of both worlds? Why wouldn't I always buy a call option? And you would be remiss to not think that. So from my perspective, that is a genuine statement and that is true. But it's important to understand what is the trade-off. And there's always a trade-off. And sometimes, in my opinion, this trade-off is actually quite large that it's not worth it. So let's explore what those trade-offs are, which is the fact that you paid 4 crowns to get into to have this option, which requires the stock to make a 4 crown move before you even break even. So think about that before, right? When you buy a stock, the stock only has to move up by a little bit before you start making money. So if the stock moves up by 4 crowns, you make 4 crowns. Here, if the stock moves up by 4 crowns, you just break even. And remember, it's not just that the stock has to move up by 4 crowns. It has to move 4 crowns by the time the option expires. So you also have a time thing to think about, right? So the stock has to move a sizable amount before the expiration of the stock just for you to break even, which means that if you get the directional view correct and it moves up by 4 crowns, you don't show any profits. You actually just have a big fat zero because you've only broken even. You didn't make any profits. You have to have the stock move beyond 4 crowns in order for you to be profitable. And that actually is the crux of what's difficult about buying an option, is that you need the stock to make a relatively sizable move in the amount of time before the option expires just to break even. So you really have to believe that the stock is going to make a very sizable move to the upside in order to be worth buying a call option. So I want to make one clarification. This is not just technically a bullish strategy. That's not correct. Bullish by a certain amount. And what amount is that? It depends on how much you have to pay for the call option. So does that make sense, everyone? Please type 2 into the chat window. That you can't just say, I'm bullish, I'm going to buy a call option. You have to say, how much does the option cost? What's the break-even price on the option? And do I think the stock is going to exceed that break-even price by a sizable margin in order for it to be worth buying my call option? Now, that is very, very different than saying, I'm bullish on a stock, let me buy a call option, okay? So there's a very distinct difference between buying a call option and just saying I'm bullish on the stock. You really have to look at what's the price of the option. Is it relatively cheap? Is it relatively expensive? And do I think the stock is going to break above that specific price on expiration? And you can use the options play tool to help you figure this stuff out. You can type in any symbol. And if you want to take a look at, let me turn this back into English so that I can read it. But on the options play platform, you have trade ideas and watch lists on the left-hand side. You have your security analysis panel here in the middle, and you have trading and income. And trading and income here on the right-hand side always provides you with 2 comparisons, buying the stock and buying a call option for any stock that you type in. So for example, if we want to look at H&M, let's say we want to take a look at a bullish position here in H&M, I can pull this up and I can look at buying a call option versus buying a stock in H&M. So let's say I'm looking at buying 100 shares, which will cost me 12,000 crowns, or I'm looking at buying a January 122.5 call option for 930 crowns. As you can see, I'm leveraging my capital. I'm controlling the same 100 shares for a fraction of the amount of capital. But the downside is my break even on the stock is 124. My break even on the call option is 131. So I really have to go to my chart and say, granted this stock recently just broke out from this major resistance level, which is fantastic. That's great. But do I think the stock is going to exceed 131? And remember, 131 is right here. It just happens to be some prior resistance. So maybe it reaches that 131 level and starts to bounce lower. So then I have to ask myself, do I think H&M is going to exceed 131? And maybe you do. Maybe you're saying to yourself, I do think it's going to break out above 131. The stock hasn't particularly performed very well over the past few years. I think it's past this kind of downtrend, and I think there's substantial upside. If you're in that camp, great. The call option makes a lot of sense, because if the stock does break out above that 131 level, maybe it gets up to 142, as you can see here, you make a 14% return on the stock, but you make 117% return on the call option. Makes a lot of sense, right? Especially if you consider I'm risking a lot less capital to make a lot higher return. But if, let's say, you think that the stock could stall at that 131 resistance level, well, guess what? You might be better off buying the stock, because you're looking at a 5% return on the stock versus an 8% loss on the call option. And it all depends on how much this call option cost. Because if this call option costs $6, 6 crowns instead, then you will be profitable if the stock reaches 131. Or if, let's say, the call option cost 11 crowns or 12 crowns, then it wouldn't be profitable. So again, not only do you have to believe that the stock is bullish, you have to look at the cost of the call option and whether or not you believe the stock is going to exceed the break-even cost of that strategy. Does that make sense? Please type 3 into the chat window if that makes sense to you. And this is a very, very fundamental, important concept to understand when it comes to buying a call option. And you have the same challenge with any option purchase, is that you have to overcome the cost of that purchase. And many times you will find that the options market is pretty efficient at pricing the implied move. And that's why we call it implied volatility, because the 34% implied volatility is backed out of this 9 crown options price. The market is implying that this is the volatility of the stock, and we expect the future volatility to be roughly 35% over the next year. So in 1 year's time, we expect H&M to be within 35% of the current price 68% of the time. So options are pretty efficient at pricing this. So only if you believe the stock is going to make an outsized move, does it make sense to buy a call option. Otherwise, you will find many times over the long run, you will largely just break even if you're buying call options, which is why if you look at professionals, rarely do you see professionals consistently buying calls or puts, because buying calls or puts are expensive, and it's rare that you're going to find an occasion where you think the stock is going to make a substantially larger move than what's required to break even. Okay, so let's now talk about the second bullish strategy, which is selling a put option. Now, selling a put option is a completely different obligation and completely different set of risks, but we're going to put that aside for 1 second. We're just going to look at it from a practical perspective, right? So I'm bullish on a stock, XYZ stock, and I think the stock's going to go higher. So selling a put option technically is also bullish. But one thing that you have to remember with selling a put option is that you're collecting income, which means that as the trade is going in your favor initially, but one of the characteristics of selling a put option is that what you can make is completely limited to what you collect on the trade. But what you can risk is somewhat unlimited, meaning the stock can continue to decline, and the further it goes, the more money you can lose. And the first time you glance at this type of strategy, you might say to yourself, why the hell would I ever trade something like this? You look at this strategy and you say, this makes a lot of sense, right? I can make a lot of money while risking a very small amount of money. And then you look at this strategy, you say, I can only make a little bit of money, but I can lose a lot of money. And you might say to yourself, that's a strategy that I want to avoid. But there's, again, with everything, there are trade-offs, and you might find that those trade-offs might be worth your while. So this is really something that's important to understand. So let's say I have 100 crown stock and I sell a 100 crown put option and I collect 4 crowns for that. So my max risk is 96 crowns and my max reward is only 4 crowns. Who would ever in their right mind risk 96 crowns to make 4 crowns? One, you have to remember the stock has to go to 0 by the time the option expires in order for you to actually risk 96 crowns. In reality, your risk is substantially smaller than 96 crowns. It's just technically speaking, 96 crowns is correct, but the reality is that it's much lower. And that's really kind of where I hopefully will shed some light for you. And the benefit here is that if you are correct, right, you're bullish on the stock moves higher, you're going to make your 4 crowns. But even if the stock doesn't move, you still make 4 crowns because you collected 4 crowns. And if the stock doesn't move, it doesn't make sense for the option buyer to exercise in their contract. So what they paid you, you keep. Think about it, someone paying you, it's similar to you selling an insurance contract that someone paid you a premium for, but they didn't exercise on the insurance because they didn't need to. So you keep the premiums. That's kind of how you should think about buying or selling an option. You're the buyer of the insurance contract and you may use it later, or you're the seller of the contract and you might have to take on the obligations. You don't, as a seller, you don't have a choice. You're just collecting the premiums and you're taking on the risk. But even if the trade goes in the opposite direction, you expect it to. So you think the stock's going to go higher, but let's say the stock moves a little bit lower. Guess what? You can still be profitable. So not only are you profitable if the trade goes in your favor, even if the trade starts to go against you a little bit, you're still profitable. So that's the trade-off that you're making when you're selling a put option. That's the trade-off that you make when you take on the obligations. The buffer, the premium that you collect is the buffer that you get against moves against the stock. Only if the stock makes a substantial move against you do you start to lose money. And you really have to consider how far does the stock need to move before this is actually going to be the case. So let's flip this to put. Let's take a look at selling a put option here instead. So now, instead of buying the 122.5 call, I'm going to sell the 122.5 put. So here I'm collecting $5.6 crowns in this particular case, right? So I can either buy 100 shares of the stock or I can sell this put option. And as I was showing you here before in the P&L simulator, yes, if the trade goes in the direction that I expect it to, I'll make my full profits. But even if the stock stays where it is and it doesn't move, I still make my full profit, right? So this is one of the only strategies where if the stock doesn't move, right, you will still make your full profits. Here I make 0% on the stock, but here I make 100% of my gains. That's a benefit of selling the put option. But even if the trade starts to go against me, right? Let's say the stock declines to 119. It's currently trading at 124. Even if that happens, I'm still profitable versus buying the stock, I have a loss. Now, only if the stock starts to make a big move do I start to lose money. But one of the interesting things you'll notice is that the amount that I lose on the stock is always going to be larger than the amount that I lose on the put option. So think about that for 1 second, right? You were prepared to take on the risk of buying the stock, right? If you bought 100 shares of the stock, you would take on 12,400 crowns of risk, and the stock declined, you would lose money. Here, by selling a put option, you lose this, you have the same risk obligations, but you actually lose less because you collected premium. And that's really some of the things that you should think about. And also you should think about what is a realistic amount for the stock to move against me, right? 106, think about 106. 106 is down here, right? So if the stock declines back to 106, then instead of losing 9,600 crowns, you're only in this particular case losing about 1,000 crowns. So put that into perspective, right? 9,600 crowns versus 1,000 crowns. Very big difference in those two numbers, right? The 9,600 tends to scare a lot of people away versus, in this particular case, 11,000 crowns versus 1,000 crowns. So that technically I can lose up to 11,690 crowns, but reality, if the stock declines 1 standard deviation lower, I'm only losing 1,000 crowns. So that helps put into context the 560 crowns I can potentially make versus the roughly 1,000 crowns that I possibly might lose if the stock takes a fairly sizable decline. Yes, the stock can move more than that, right? The stock can always move higher. Substantially lower, but you can get a sense for how much you can lose. And what you're going to see is that because you make money most of the time with this type of strategy, that in the long run, yes, there will be some puts that you lose more than you can potentially make on, but you're going to win far more. You're going to win at least 50, 60% of the trades. That's going to offset some of those larger losses. So that is a key differentiator between buying a put option versus selling a call option. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. So if you understand these concepts, the next 2 slides will be really easy, because buying a put option and selling a call option is just an exact mirror image of what we just spoke about, but for bear strategies. So if you think the stock is going to decline, you can buy a put option, and it gives you the same characteristics of a long call: unlimited potential gains in exchange for limited losses. For many investors looking at this for the first time, it seems very attractive, but just like buying a call option, what you pay for that put option, you have to overcome in the stock moving lower beyond that level just to break even. And that many times in the long run, if you look at just buying calls or puts, you will find that buying calls or puts is a very, very difficult strategy to make profits from in the long run, because of the amount of premium that you pay and the amount that the stock has to move in order for you to be profitable. That even if the stock sometimes exceeds it by a small amount, you're not getting rewarded enough for the amount of risk that you're taking if the stock even just doesn't move. Because even if the stock doesn't move, you're still paying out the premiums. Versus selling a call option, you get the benefit of selling, of taking a bearish position, but doing in a way where you have multiple ways to be profitable and one way to be severely unprofitable. I will say that, even though there's a preference for selling puts and calls, I don't advocate that you go out there and sell calls and sell puts. There's a progression to this, right? This is just the first step in understanding the building blocks. This is not necessarily the strategy that you end up pursuing in your portfolio. We'll talk about in the 4th session of this series of what you can do to have this risk profile, meaning having the potential gains like this, but also do it in a way with limited losses, so that you don't have this unlimited loss here to the downside. But we have to crawl before we can run. So the first step is just understanding the difference between selling a call option versus buying a put option. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. So let's now merge what you learned last week with what you've learned here this week, which is understanding the Greeks in a more in a way that's connects the dots, if you will. So a lot of times, we learn about, okay, we can buy a call option, and if the stock goes higher, we'll make money. But it always comes back to, okay, if the stock goes higher by a certain amount, how much money do I make? And that is, let me actually back up for 1 second. What you're going to learn here in this section is very important, but it also involves a heavy amount of math, or rather, it just involves a heavy amount of numbers. And for those of you that are interested in learning about it, I think it's important to understand this as a concept, but I don't think you need to understand the math, and you certainly don't need to understand the numbers behind it, because platforms like Options Play do all of the work for you, right? You just have to use this price slider. You can say, I think the stock's going to go to 140, and we will calculate for you the potential profit and the potential loss. You don't have to do this manually, but it's important to understand how it works on the back end. Okay, so I'll talk about 3 Greeks today that are important for trading options. The first one is going to be called delta. Delta tells you the change in the option price with respect to the change in the stock price. Basically saying, if the stock moves by a certain amount, how much does the option price move in that same direction? So if you have an option that has a delta of 0.5, and let's take a look at the option contract that we're looking at before. I'll switch this back to call options. We're buying the January 2023 122.5 call option. So if you use the strike dropdown, you'll see that the 122.5 call option costs 9.3 crowns, and it has a 0.58 delta. The third number here is delta. So this tells you that the option has a 0.58 delta. So what does 0.58 delta means? It means that if the stock moves up by 1 crown, the option will move by 0.58 crowns. Okay, so if you have a delta of 0.5, that means that the option will move up by half a crown for every 1 crown that the stock moves higher. So if you have a call option, a 140 crown call option that has a 50 delta, and the stock goes from 140 crowns to 145 crowns, right? That's a 5 crown move. Then that option will gain from the 10 crowns that you paid to 12.5 crowns. So a 3.5% gain in the stock underlying resulted in a 25% gain in the underlying options position that you have. So that's the leverage factor that you can get from options, right? So the stock moved 3.5% higher, but you made 25% on your option because you paid substantially less for the option. You only paid 10 crowns versus 140 crowns that you have to pay for the stock. So that's a leverage that you get, and Delta helps you understand, based on that leverage you have, how much would you potentially make if the stock moved in your favor, and also if the stock moved against you, right? So if the stock moved down by, let's say, 3.5%, right? Let's say it moved down to 135. Well, then I know that I'll lose about 25% of the premium that I pay on the option. So Delta just gives you a sense for, if the stock moves in a specific direction, how much you will make or lose on the option. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Now let's talk about time. Now, as I said before, with all option contracts, you have a time component. And the value of an option decays, meaning it decreases as it approaches the expiration of an option. Think about an insurance contract. Think about buying insurance for a year versus buying an insurance for a week, right? The insurance contract for the week is going to cost substantially less than the insurance contract for the year. Now, it's not a linear scale. It's not like 1 week will cost you 1/50th of an insurance contract for a full year, or a 10-year insurance contract is not going to be 10 times more expensive than a 1-year contract. It is not on a linear scale. So theta gives you an understanding as to what is the change in the value of an option as time erodes. As you get closer and closer to the expiration of the contract, what is the decrease in value of the option contract? And when we think about theta, so when you look at theta, so for example, if let's say you have an option contract that has a theta of 0.06, that tells you that the option price is losing 0.06 crowns per day. Remember, it's always per day that we're looking at in terms of theta. And it's really only accurate over per day, meaning if you're looking at a longer period of time, theta will change over time. So you have to look at it as it changes over time. So in the previous example, I talked about buying a call option on H&M and H&M stock increasing from 140 to 145. But let's say that happened over a 1 week time. So the stock gained 3.5% over 1 week's time. So there's two components that we have to talk about. There's delta, which is when the stock goes from 140 to 145. The 50 delta that I'm referring to told me that the option contract went from 10 crowns to 12.5 crowns. That's a 25% gain. But remember, it took a week for that to happen. And for every day I was holding on to the option, I lost 0.06 crowns. So over that 1 week's time, I lost 0.42 crowns to time value. So that means that the 12.5 crown option that I had is now only worth 12.08 crowns. So now my gain erodes from 25% down to 20% or 20.8% to be more accurate. So you have two components that you have, and arguably delta and theta are the two most important components because those are the two that have the largest impact on the value of your option. It's how much does the stock move and how much time does it take for that to happen. So like I said, while this is important, you don't have to do the math yourself because our platform does the calculations for you. And so these are, in my opinion, the two most important Greeks to understand. And the P&L simulator actually does all of that work for you. So you don't have to actually do the math. You can just use the price slider and say, I think the stock is going to go to this specific price, and I think it's going to happen by this specific date, or I want to hold it all the way to expiration. And you can see what your potential profit is if the stock makes that move, or if it makes that move in a short amount of time versus if time continues to go on, right? So here, this is what I was referring to before, right? So if, let's say the day after you buy the option, the stock makes a sizable move here to the upside. All of a sudden, you find yourself, you're up 50% on the option. Let's say the stock moves up to 135, right? You find that you're up 56% on the option. But instead of selling the option at a 56% gain, let's say you continue to hold on to the option. And what you see here is the value of this option starts to erode every single day you hold on to that option. And it erodes by the amount, the theta amount that I was referring to. And theta actually accelerates as you get closer and closer to expiration. So every day you hold on to this, if the stock doesn't move, let's say it stays at 135, the value of the option that you own will continue to erode. And this is why when you're buying a call option, you don't want to hold the option to expiration. If you see a profit in the call option, it's usually best practice to sell the option at a gain and maybe buy a new option, right? So lock in the gain before you just continue to hold on to it. Because if you continue to hold on to it, one, you have the opportunity that the stock declines again and you see a loss, but even if the stock doesn't decline, you will still continue to see erosion in the value of your option. So hopefully delta, and the price slider is really the delta calculation, and the time slider is really the theta calculation. Those are the two things that have the largest impact on the value of your option. And as an option seller, the exact opposite happens, right? So if I sold this put option and the stock and the strategy and the stock goes in the direction that I expect it to, let's say it does it in just a few days, right? Let's say the stock goes up to 135. Now, I'm not going to make my full profit, but I'm going to make 44% of my profit. And for each day I hold on to it, the theta decay works in my favor, right? So this is why option sellers, this is why a lot of people prefer selling options, because even if the stock doesn't move, they're going to continue to make a profit on their trade as they hold on to the trade, versus as a buyer of the option, for every day you hold on to it, some value starts to leak in the value of your option. So hopefully that gives you a good understanding of the difference between buying versus call options and the two primary influences that change the value of a call or put option that you are either an owner of or you are a seller of. So with that covers what I wanted to share with you here today. Like I said, if you don't have access to Options Play to do the work that I just showed you here today, you can sign up for free at optionsplay.se in partnership that we have with the NASDAQ exchange, offering it to you completely free of charge. So with that, what I'll do is I'll open this up for Q&A. If anyone has any questions, feel free to type your questions either into the chat window or the Q&A window, and I'll try to answer as many questions as possible before I have to sign off. Any questions? Well, I'm going to cover the effect of Vega. I wasn't planning on, but I certainly can. Vega is basically implied volatility. So as implied volatility changes, it also affects the value of your option. But as you can see, even fairly significant changes in implied volatility have relatively small changes in the value of your option. And the reason that I don't teach a lot about Vega is because most people don't have a view on Vega. Most people have a view on where they think the stock is going to move, but most people don't have a view as to whether the future expected volatility of a stock is going to either contract or expand. And largely, Vega follows sort of seasonal patterns based on where earnings are going to be. So as you approach earnings, you tend to see Vega turn higher, and then once the earnings announcement comes out, Vega will start to collapse. So that's the only kind of thing that you can use to gain a view on volatility or implied volatility. So it's here, and you can see the effect that it has on your option contract. But like I said, it's generally speaking a relatively small change. As you can see, if the Vega expands, the value of mine goes from 86% to, let's say, 81%, or if it contracts, it goes from 81% to 90%, 91%. These are not values that are going to shift your views on whether or not you're going to sell that put option. It's, you can make some minor adjustments to get more accurate results, but I think most people, don't necessarily say that, oh, I think implied vol is going to go from 35 to 30. It's just not something that most people have a view on. Yes, this is recorded, and we will send out the recording after we finish. You're very welcome, Jacob. Any other questions regarding buying versus selling options? Anders, you're very welcome. Thank you so much for the kind words. Karen, thank you so much as well. If there are no other questions, I will sign off here for today and leave a few minutes for you to sign off early. We will send you both the recording and the slides so you can follow along at your own pace. And feel free to send us an email if you have any questions. Thank you so much for your time this evening. And Jessica will be back here next week to talk about technical analysis and options. So I'm really looking forward to that session as well. And I'll be back the following week to talk about how you can take what you've learned today and take it one step further, and take on some of these risk-reward ratios, or rather the risk profiles, without the unlimited loss when you're selling a call or put. So really looking forward to that. Thank you so much. Have a great trading day, and I'll see you guys here in 2 weeks' time.